Markets are reacting to two shocks at once: the risk of a prolonged U.S. Iran energy crisis and the first real pause in the AI-led stock rally. Friday, June 5, 2026. Like and subscribe for daily market updates. Today's agenda: the two shocks, market snapshot, macro transmission chain, geopolitical status, AI sector reset, commodities and crypto. Now let's look at the specific numbers defining this choppy session. Welcome back to Market Pulse Daily. Today, we are seeing a very specific and complicated mix of events driving investor behavior. We are not just seeing one headline, we are seeing two major shocks happening simultaneously. First, there's the risk of a prolonged energy shock stemming from the US-Iran conflict. Oil prices are sitting above $90, which keeps inflation fears alive. Second, we are seeing a pause in the AI-led stock rally. This is not because AI demand has disappeared, but because expectations were already set for perfection, and recent reports like Broadcom's showed that perfection is not guaranteed. This creates a difficult environment where investors are trying to price in lower interest rates and a gradual economic slowdown without recession, but an energy shock pushes inflation in the opposite direction. At the same time, the AI trade needs strong available cash in the market and strong earnings revisions. When both of these factors are questioned at once, the market becomes choppy. We are seeing a rotation away from the most crowded risk trades. Value stocks, healthcare, and some financials are holding up better than high-multiple technology stocks. This split tells us the market is not collapsing, but it is definitely not complacent either. The central question for every investor today is simple: does this conflict stay contained, or does it become a full-blown inflation shock that forces the central bank to keep rates higher for longer? With stocks mixed, let's understand the big-picture economic chain driving these moves. Let's take a snapshot of where the major assets stand right now. The US stock market closed mixed in the latest verified session. The S&P 500 finished at 7,584.31, which is up 0.4%. The Dow Jones Industrial Average closed at 51,561.93, up 1.7%, and it hit a record close. The Nasdaq Composite finished at 26,830.96, down 0.1%, pressured by weakness in AI-linked and semiconductor names. That split is important because it tells us the market is rotating, not collapsing. Value, healthcare, financials, and some defensive areas are holding better. High-multiple technology is more vulnerable because how expensive assets look relative to earnings is already high. In Europe, the stock 600 recently rose to 624.45 as lower oil prices temporarily improved investor mood, but Friday's global tone is weaker. European markets remain more exposed to energy import inflation than the US, so the Iran story matters directly for the European Central Bank and for corporate margins. In bonds, the 10-year Treasury yield near 4.48% shows that investors are not pricing an easy rate change. The dollar is supported by a safe place to store wealth demand and rate expectations. Gold is still high, but it is under pressure from the same higher real yield logic. Crypto is weaker. Bitcoin and Ethereum are trading more like high-beta assets under pressure from dollar strength and risk reduction. The market mood is mixed but defensive. There is no broad panic selling, but there is a clear rotation away from the most crowded risk trades. Now let's dive into the geopolitical status that is fueling this entire chain. The macro story is now built around one transmission chain: Iran, then oil, then inflation, then the central bank, then the dollar and yields, and finally stocks, gold, and crypto. The difficult scenario for the Federal Reserve is not simply higher inflation. It is higher inflation at the same time as weaker consumer demand. That is the stagflation-style risk investors are watching. For now, the evidence is more inflationary than stagflationary. The U.S. labor market is slowing but not breaking. Economists expect May payroll growth around 85,000 to 105,000, depending on the survey, with unemployment expected near 4.3%. Recent central bank commentary has moved away from rate cut language. Kansas City Fed President Jeffrey Schmid described the choice as patience versus rate hikes to bring inflation down. A Boston Fed research paper argued that today's U.S. economy is less vulnerable to oil shocks than in the 1970s because it is more energy efficient and has more domestic production. But that does not remove the inflation problem. It only changes the policy trade-off. For markets, the message is straightforward. If oil stays high, the central bank has less room to ease. That supports the dollar and keeps real yields firm. Stocks can still rise, but leadership becomes narrower. Gold can hold a geopolitical premium, but higher real yields cap upside. crypto suffers if the dollar strengthens and available cash in the market tightens. This is the core transmission chain we must watch. This geopolitical tension is hitting specific sectors, particularly the AI and tech names. The main risk remains the U.S.-Iran conflict and the wider Middle East spillover. The latest reporting shows that hopes for broad settlement have weakened after Hezbollah rejected a U.S.-mediated ceasefire framework in Lebanon, while Israel continued operations in the south. That matters because Lebanon is tied into the broader negotiation architecture around Iran, regional proxies, and the Strait of Hormuz. Oil is not trading only on ordinary supply and demand. It is trading on peace deal credibility, Hormuz traffic, Gulf infrastructure risk, naval posture, and inventory risk. Reuters reported Brent near $95 and crude oil near $93, supported by uncertainty over U.S.-Iran talks and disruptions at Oman's Mina Al Fahel terminal. The market is treating Hormuz as a live risk channel, not as background noise. For the United States, the conflict does not have to reach U.S. soil to matter. It can reach households through gasoline, diesel, food logistics, airline tickets, and weaker discretionary spending. It can reach companies through transport costs, input costs, and lower margins. It can reach financial markets through inflation expectations, the central bank, the dollar, and earnings price-to-earnings ratios. The scenario map is simple. In a limited retaliation scenario, oil stays elevated but stock damage is contained. In a Gulf infrastructure or U.S. base attack scenario, risk assets come under pressure. The dollar strengthens and gold receives a stronger hedge bid. In a major Hormuz disruption, markets would price a more serious oil shock, delayed easing or even hike risk, and lower growth. In a diplomatic cooling scenario, the oil premium fades and stocks stabilize, especially if the AI sell-off does not broaden. Let's look at how commodities and crypto are reacting to these macro and geopolitical pressures. Second market driver is the AI reset. Broadcom's underwhelming report was enough to trigger a sharp sell-off in semiconductor and AI-linked stocks. The key issue is not that AI demand has disappeared. The issue is that expectations were already expected by the market for perfection. This creates a clear winners and losers framework. Potential beneficiaries are energy producers, selected defense names, parts of healthcare, some financials, short-duration cash-like assets, and gold as a hedge. Areas under pressure include airlines, transport, consumer discretionary stocks, high-multiple technology, and crypto if the dollar and yields keep rising. This is the market contradiction of the day. Investors still want to price lower rates and a gradual economic slowdown without recession, but an energy shock moves inflation in the opposite direction. At the same time, the AI trade needs strong available cash in the market and strong earnings revisions. If both are questioned at once, the market can remain choppy even if headline indices do not collapse. We are seeing a repricing of expectations, where the market is no longer willing to pay premium prices for growth without immediate proof of earnings. This rotation is healthy in the long run, but creates short-term unpredictable price swings for tech-heavy portfolios. Finally, let's summarize what investors should watch over the next few days. Oil remains the main macro asset. Brent near $95 and crude oil near $93 are high enough to keep inflation risk alive, but not yet high enough to force a full market break. The next move depends less on yesterday's inventory data and more on whether the U.S.-Iran negotiation track improves or deteriorates. Gold is near $4,443 per ounce, normally. Geopolitical tension supports gold as a safe place to store wealth. Gold is now facing a two-sided market, a safe place to store wealth demand on one side and higher real yield pressure on the other. That is why gold can remain elevated without moving straight up. Silver is below $73 and is more sensitive to growth expectations than gold. If markets price weaker industrial demand, silver can underperform even while geopolitical risk stays high. Bitcoin is around $63,300 and Ethereum is near $1,730. Bitcoin is not trading today like a pure safe place to store wealth. It is behaving more like a high beta available cash in the market asset under pressure from dollar strength, higher yields, tech weakness, and risk reduction. If the conflict creates monetary stress later, the narrative could change. But right now, crypto is following available cash in the market and risk appetite more than geopolitics. Investors need to understand that crypto is currently a risk asset, not a hedge against the specific geopolitical risks we are discussing. To wrap up, markets are not in full risk-averse mode, but they are definitely more defensive. The US-Iran conflict is the dominant macro shock because it connects directly to oil, inflation, the central bank, the dollar, and consumer spending. But it is no longer the only story. The AI trade is also being a repricing of expectations, and crypto is showing that available cash in the market matters more than the safe place to store wealth narrative. The biggest risk is a prolonged energy shock that keeps inflation sticky while growth slows. The biggest opportunity is not a prediction, but a condition. If diplomacy improves and oil risk fades, the market could stabilize quickly, especially outside the most expensive parts of technology. For now, the right lens is not panic. It is transmission. Iran affects oil. Oil affects inflation. Inflation affects the central bank. The central bank affects the dollar and yields. And those two variables are now driving almost every major asset class. Thanks for watching Market Pulse Daily.